We can now look at part A of the required. Question 1 says, discuss the normal tax consequences of events 1 and 2 for the year ended 31 December 2023. You are now required, you are required to provide calculations to support your discussion. You must assume that Molecule would choose any option available to it to reduce or defer its tax liability in a legal manner. Okay, and they say discuss. Now, I'm not going to show mine, I'm not going to write out too many sentences, but I'm going to take you through it, what I would, I'm going to do it in a calculation form a little bit, just to, because I think we all know what that looks like, and then I'll take you just through the solution with that also. So let's look at event number 1. Now what happened in event number 1? There's a couple of things that happened. Is they bought, they purchased assets. Event 1, there's assets that were purchased. So for these assets that were purchased, you must claim capital allowances on those. So you need to do something, you need to talk about this in your solution. And then there's section 24I on what is called the exchange items. As you'll recall, section 24I is calculating exchange items. And which are the ones that we identify in this question? Well, there's the foreign debt and there's the FEC. So we need to do the discussion around that. Now you'll also recall what happened in this question is that we entered into the transaction in the year 2022. We entered into the year 2022 into the transaction. However, we only brought these assets into use in the year 2023. So section 24I7 applies, which says the amounts from 2022 that should be calculated, the forex gains and losses, will not be done there, but they will be carried across into the next year. So you're going to have to discuss that in your solution as well. So section 24I7. And that's basically it for event number 1. For event number 2, there's the sale of machine X. So we'll have to consider a recoupment, we'll have to consider capital gain, and then there's the buying machine Z, where we will apply paragraph 66 and section 84E. So those are the things that you have to discuss. As long as you discuss these points, you should get the majority of your marks, if not 100%. Okay, so let's go and see to it. So I'm going to do it in the form of a question, guys. And indeed, when people set questions, and when I said this question as well, we think about it in terms of how it would be calculated. Now, what I'm going to do, guys, is, so I'm going to show you a couple of things. So as we just discussed, for event 1, there will be assets that were purchased, so you have to calculate the capital allowances, and then we have to do section 24I. So let's start by doing the assets that were purchased. Okay, so cost of assets, the calculation. We have the mainframes, you'll remember, and the tablet computers. So let's do the two costs. So the computer has a cost of $2,500 and the tablet has a cost of $800. Now those are in stated for us in dollars, right? As you can see, I'm not fantastic at doing dollars. It looks like an and sign. So these are assets, and this was imported on the 1st of February of September 2022. That's our transaction date. That's when risk and rewards transfer. So at 16 rands 50 is what we need to translate this at. Okay, and then what do we know? There were also import duties. And they tell us that the import duties are 2,500 and 1,000. So that forms part of the cost. Right, and for each of those, there were 3 units purchased. Okay, so that gives us the cost of the assets. Right, so the reason why I'm showing it separately is in your discussion you'd have to address that and these costs, how they were calculated. Now let's do our capital allowances on these assets. Right, so guys, now please remember for both of these, because these are section 12E assets, it's going to remind you. Right, E1A assets, they're wear and tear assets. They can choose either section 11E or 50, 30, 20. And you do this per type of asset, so per mainframe and per tablet. So you look at those 2 categories. Okay, so let's actually can use either section 11E or section 12E 1A. Okay. So let's look at the mainframe computers. The mainframe computers, 5 years is the write-off period if they use section 11E. If they use section 12E1A, it's 50, 30, 20, so 3 years. So in this case, we'll use section 12E1A. So thus, section 12E1A, our allowance on these computers, the 131,250, this was the first year that they were used, so you can claim 50% of that. And that would be a deduction for you against your taxable income. The tablet computers, section 11E tells us they can be written off over 2 years, section 12E is over 3 years. Now what is important for you to remember is that section 11E requires it to be apportioned, and they tell us here that it was started to be used from the 1st of February. So I'm going to say here, we'll use section 11E, and this is from February to December. So it's 42,600 divided by 2 years times 11 over 12. All right, so that gives that. Now, some of you might argue here and say 50, 30, 20, they could have claimed the full 50% if they used the 50, 30, 20 instead of apportioning it by 11 over 12, which is a fair point. But in the second year, you'll claim more on the tablet. So just for exam purposes, go with the principle that section 11E and section 12E1A, you compare the periods that it will take to be written off. That's the idea which I would like you guys to just follow. Now, okay guys, so I want you to see all of those things that we've just discussed. If you go to your solution, these are very simple stuff, guys. They can apply, you just talk about all of these costs. Here's all of those costs, everything that we've discussed. Please make sure that you go and see all of these rates. You basically just put in words what we've put down. So you can see mainframe computers. They would select apply section 12E1A, and then you do the calculation. Right, with the full calculation. Then they will apply section 11E, do the calculation. or for the cost, do the calculation. As you can see, it's really quite simple. Okay, now let's go to the next part of event 1, which is the section 24I stuff. Okay, so section 24I, Forex gains or losses. So I'm going to say section 24I7 applies as the asset was brought into use only in 2023. Right, so that would mean that the 2022 gains and losses are included in 2023's taxable income. Okay, so I'm going to do it per exchange item. So I'm going to do it, let's start by doing the foreign debt. And what I recommend we do is we start with the year 2022. Let's do that Forex gain or loss first. Now I'm going to remind you, the date, the Forex gain or loss we're calculating is from the 1st of September 2022. That's the transaction date. And we're calculating that now until the end of the first tax year, which is the translation date. If I show you on the table here, it's from transaction date to translation date. That's what we're now doing. So on transaction date, we thought we're going to pay 16 rands 50, but at translation date, we see that we're going to pay 17 rands 45. So we're going to end up paying more than what we anticipated. So that is for us a Forex loss. Okay, now in my case, we've already calculated the cost of these assets. Or we know that it is, rather let me just show you what I mean. We know it's $2,500. So 2,500 and 800 equals 3,300. Okay, 3,300. So the sum of those times 3. So let me just, yeah. So let me actually explain to you what I mean. So let's write it down here at the bottom. Total value of debt. A computer is 2,500. A tablet is 800. That gives us 3,300 times 3 gives us 9,900. And that is the dollar amount, 9,900. Okay, so the Forex loss on translation date is that's $9,900 times, I always say, latest rate first, then the previous rate, so 745 minus 1650. Now again, if you just calculate this in your calculator in this order, it obviously calculates a Forex, or it looks like a gain for you, but you need to know it's a loss. Sorry, and this will be deducted. Make sure that you see against your taxable income. Then let's do the 2023 Forex gain or loss for this foreign creditor. So now it goes from translation date to realization date. So at translation date, we thought we were going to pay 17.45, but we ended up paying 15 rands 40. So that's a Forex gain on the realization date. And the realization date, 1st of March 2023. So this is the actual forex gain loss for this year. So 9,900 times 15 rands 40 minus 17.45. And that gives us 22.95, and that amount, make sure you see, gets included. Right, so that's it for the foreign debt. Now, let's do it for the FEC. So we do the 2022 one first. Now, as a reminder, the FEC was taken out on the 1st of October 2022, and we have to do that to translation date. That's the one we're calculating first. This FEC was an FEC taken out on the 1st of October to be settled 1st of March. So it was for October, November, December, January, February, March. It was a 5-month FEC. October, November, December have passed already. So we've got 2 months left. Or you can say January, after New Year, January and February must pass. So 2 months before it's done. So we know we need to compare this. So 17 rands 50 compared to 16 rands 20 is our first one that we do. So we say, when I took out the FEC, I entered into a contract to pay 16 rands 20. If I had waited until the 31st of December, right, like we can see here, I would have paid 17 rands 15. So because I'm paying less, I'm making a gain here. So this is a 2022 forex gain on translation date. 31 December 2022. Right, and the FEC is for the same value, dollar value, so $9,900 times 1715 minus 1620. $9,405. Okay, then we need to compare our 2023 forex gain or loss on realization date. So 1 March 2023. Okay, is it a gain or a loss? Let's go and see. So our last rate that we now restated this to was this 17 rands 15. So we basically now say we're saying 17.15 is what we would have paid. We now compare that to our year end or our realization date value of 15 rands 40, and we see that it's too high, so we have to decrease it. This is a forex loss. Okay, so guys, all of those amounts, I'll just now take you to the solution to see you. Forex gain and losses, you always tell them that it's calculated on exchange items and what those exchange items are. You talk about section 24I7, and then you do the calculations. Right, make sure that you add, say whether it needs to be added or deducted from taxable income. Now let's do event number 2. Okay, so same thing, I'm going to do it as a calculation. Okay, so first up is the sale of machine X. So what do we always do, guys, when we do a sale of an asset? We start with the calculation of a recoupment. So the cost of this asset was 2 million. less our section 12E1A, sorry, not 1A, that's the incorrect one, section 12E1 allowance. This asset was brought into use in the year 2021, so that's when we claimed our first allowance. And how much was that allowance? It was 2 million times 100%. Not 40%, guys. Remember, it's a small business corporation. So this means that the tax value when sold was null. Make sure you see there's nothing included in the current year for that allowance because it was fully claimed in 2021. You need to show it that you understand that. Right. How much was this asset sold for? For 1.5 million rands. So, selling price, and remember, we always say you're limited to original cost. And basically what this means, it doesn't mean you must use the original cost. It basically, when you say that, you're saying use the lower of selling price, which is 1.5 million in this case, or original cost of 2 million. There are also other ways of doing this, guys, but this one forces the recoupment to work out correctly. So in this case, it's 1.5 million because that is what the actual selling price is. So that calculates our recoupment of 1.5 million. Now usually we take this amount right here and include it. But now we know that there might be a deferral. So I want you to see we're not doing that just yet. Okay. So let's just first do the capital gain calculation. Proceeds. 1.5 million minus the recoupment, 1.5 million. Again, just because it's not included there doesn't mean you should say it's null here. You look at this total you calculate over here, the calculation amount, because this 1.5 million will, in some form or another, get included in taxable income, and you can't tax it twice as a capital gain and taxable income. So we always use the full recoupment there, so null. Then you've got the base cost. The base cost is the cost of the asset less any allowances which have been claimed. You can't get the benefit twice. If you already claimed allowances against taxable income, you can't get the benefit again when you have the base cost. So proceeds and base cost in this case is null. And it makes sense. The asset has been fully depreciated, so that's why base cost is null. And the asset was not sold for more than its original cost. That's why it basically works out that the proceeds is also null. Okay, but now, paragraph 66 applies. Why? Because machine X sold for its base cost or more. So it means, i.e., not a capital loss. There can't be a capital loss. Will be replaced within 3 years. The question tells you that it must be, you must sign a contract within 12 months. Sorry, the act tells you contract within 12 months must be replaced within 3 years. Okay, but we know it's going to be replaced next year, and cost of new asset equals or exceeds selling price, which is that 1.5 of the old asset. Okay, so that means thus the recoupment is deferred under section 84E. Section 84E applies if paragraph 65 or 66 applies automatically. Okay, now how does it usually work? In the year 2023, I want you to see machine Z will be brought into use. We'll claim section 12E1 on that. How much does this machine Z cost? 1.6 million, sorry. This 1.6 million rands, we will claim 100% as an allowance in the year 2023. sorry, 2024. Yeah, sorry, 2024. Sorry, guys, 2024. And what we'll then do is that deferred recoupment of 1.5 million. You say 1.5 million times whatever we've done there, so times 100%, and that is recognized. If there was a capital gain on machine X, so this is the machine X. If there was a capital gain, whatever that amount was, you would also multiply by 100%. Just as a quick reminder, guys, how this section works. Let's say that was an asset that you had to divide by 3 times 8 over 12 to calculate its allowance. You would then do the same with the recoupment and the capital gain. For both of those, you'd say divided by 3 times 8 over 12. Right. Remember, that's the idea behind paragraph 65 and 66 plus section 84E. Paragraph 65 and 66 applies to the capital gain, section 84E to the recoupment. We just didn't have a capital gain in this case. Take it to the solution. Right, I did the calculation there, just to show. So I'll apply paragraph 66. You must state the molecule will choose it, because remember, it's optional. There's usually a mark or two for discussion there. And then we just talk about the deferred. Now this question asks for 2023, it didn't ask us for 2024. That's why these I had considered to be bonus marks. Okay guys, that's it for part A of the required. In the next videos we'll continue.